It's funny how everything works in cycles. I talked about property on this YouTube channel, and normally when you say property, most people think residential property, houses, units, townhouses, villa houses, something that you can buy and then rent it out to, again, people like ourselves. But nobody normally thinks about property when we talk commercial property, offices, large office buildings like the office I'm sitting in. What's happening with that market, I don't really know. I didn't know until I watched this clip. Apparently you can invest in these commercial properties. One way to invest in them is through REITs, which are retail investment trusts, and apparently they've gone up 50% in the last couple of years. But some people, and this particular analyst in this clip I'm going to share with you at the end of this video, only a couple of minutes long, is shorting it. So it's like the big commercial property short in Australia. If you watch the movie Big Short, I recommend you do. So that's what he's doing. He's going to short the REITs, retail investment trusts, meaning that he's going to make money if the value of those trusts pulls back, and he thinks that could happen 30%, 30 to 50%. So he's going to make a packet if that happens. Very interesting. Anything to do with property, the cycles are pointing downwards. Commercial property or residential property, no matter where you look, it's not looking good. So I really wouldn't be putting my money in property. I'd be sitting tight, probably buy some, as Jim Rickards argues in his latest book, The New Case for Gold. He talks about buying some precious metals, gold, maybe silver coins, silver bars. He's big on gold though. So buy some of that for, maybe bank closures, maybe bail-ins. But he recommends putting about 10% of your investable income there. The rest of it, I think big portion right now should be cash. Maybe there's still opportunities in the stock market. Some of the companies are making money. But yeah, you've got to invest in particular stocks, not the market itself, because while market is pulling back, you might be making money on particular stocks. All right, I hope you like this clip I'm going to share with you.
Property was the canary in Australia's coal mine during the global financial crisis, and now there are warnings that history might repeat itself. Real estate investment trusts, known as REITs, have outperformed the market by 50% over the past 5 years, but many are worried a correction is coming. Here's Neil Woolrich.
First, it was resource companies, then the banks. Now, some smart money is betting the commercial property sector is next in line for a sharp share price correction.
Office rents are not going to grow, in some cases declining, industrial rents much the same, and supermarket and retail-based rents are doing okay, but not as well as they have in the past.
Real estate investment trusts, or REITs, have been one of the better performing sectors on the share market in recent years, after being savaged during the global financial crisis. Since 2011, the ASX REITs index has climbed more than 50%, compared to a 3% rise in the broader market. But fund manager Tim Hannon warns the fundamentals of the commercial property market are weakening, and that could flow through to the share prices of REITs.
And when I mean negative, I'm not talking a major correction, but that we think they're 8 to 10% overvalued presently.
In the global financial crisis, the ASX REITs index lost 3/4 of its value. But in the last few years, investors have flocked back to REITs as a defensive play. Tim Hannon is so convinced another correction is looming that he's short-selling real estate investment trusts, meaning he'll profit if their share prices go down.
And we saw with the banking sector, very well sought after 12 months ago for yield, high yield, that corrected 25% in 6 months. That's the sort of thing that can happen when you chase a theme too hard and it becomes overvalued.
The commercial real estate market is reflecting the transition of the Australian economy from the mining boom to services-driven growth. Vacancy rates in Sydney and Melbourne have fallen to single digits, but in the mining capitals of Perth and Brisbane, they're closer to 20%.
And a lot of the office REITs have a big exposure to Perth. Now, that's just one example. We don't see that recovering. Rents could more than halve in Perth.